Good afternoon, everyone. Before we get started, can everyone hear me? If you can, hopefully you can, drop a note in the question box, just letting me know that you can hear me, that you can see me, not as important, but that you can see the slide that is up on the screen. You can see the slide. That's one of the more important pieces. Okay, perfect. So as a reminder, I love to make these calls as interactive as GoToWebinar will allow. So please make sure you are dropping questions in the question box. And welcome to the Grow Mentorship Series. I'm your host, Joanne Theriault-Fazio, SVP of Mortgage Lending and Branch Manager at Proper Rate and your Grow Mentorship Director. For those of you who may be first timers, a quick background on Grow. The Guaranteed Rate Organization of Women is an employee resource group for all of Guaranteed Rate companies, launched over 5 years ago. And our mentorship program was created 4 years ago. And we've had over 300 women go through the sales, non-sales 12-week mentorship program, along with some men's groups as well. And we have done over 20 mentorship series calls, actually probably even way more than that, bringing value and knowledge across all of our companies. And I am proud to say that we have a parent company that fosters the growth of women and that we have a much higher than average percentage of women originators at our companies than the industry average. Grow brings us amazing value and topics. In our last mentorship series call, our Build Your Business and programs can be found on your respective company intranet under the ERG tab, and all Grow calls are recorded and materials are uploaded, so you can go back and rewatch or view something if you've missed anything in the go back years. So you can go rewatch everything as long as it's still relevant today. I wanted to take a minute to recognize that we actually included referral partners from across the country on today's call, and this topic is super important. Normally when I teach a class or host a webinar, I like to say things like, oh, we're just arming you with some basic information on a topic. And our goal isn't to make you an expert. And that is 100% not the way I feel about this one. As a loan originator or processor, you need to be so well versed in condos, you don't even need to look up guidelines. And as a realtor or attorney, we're going to provide you with some best practices so that any bumps in the road that can occur during a buyer's purchase of a condo can be easily avoidable. And my guest speakers today are by far some of the most knowledgeable people you will ever meet. They have spent a lot of time educating loan officers and pods across the country. And I love that they are willing to open up this call and their brains to our referral partners. And today's focus is going to be on deferred maintenance and how the changes in what Fannie Mae and Freddie Mac require now and the why. And our condo team will also focus on a few other bits of information when it comes to FHA, VA, and even non-mortgage. We're going to launch a few polls during this session, and we'll launch the first one right now while I'm talking here and doing the introduction. So Ella, who is our amazing Director of Internal Communications and works with us in all things Grow, is behind the scenes to help us with that. Ella, can you launch that first poll?
Yep, and we have the results coming in.
Okay, perfect. I can't see the results for some reason, so maybe you can.
Yes, we will share them shortly. I'm able to see that about 60% of you have given your answer, so I'm going to wait a couple more seconds, and then I will share the results with everyone.
Ella is always the one that has to launch the polls for me, so I don't forget. Also,
yes,
she keeps us on track for all these calls, which is great.
Totally, and this is a very active group, so this is great. You guys are all awake and ready. So I will share the results. We have about 80% of you who shared, so that's great. And there we go, 81%.
Okay, go ahead, Elle.
Yeah, so 81% of attendees on the call at the moment are loan officers, pod members, or Guaranteed Rate Companies employees. And we have 19% that are realtors, attorneys, or referral partners of Guaranteed Rate Companies.
Perfect. Thank you for everyone doing that poll. A couple of you have made comments in the question box that you don't have sound. It seems like pretty much everybody can hear us. So if you can't, you just might need to log off and hop back on and check your microphone on your phone if you're doing phone, iPad, computer. Anyway, launching back into our little intro here. I do want you to be experts in this topic. The next time you're at a party with friends, someone brings up wanting to purchase a condo, I want you to sound so smart, prepared, and professional that they won't even question what you're saying. So put down your phones for the next hour and let's dive in. I'm excited to introduce our condo team leads to you. We have one on camera and two not on camera due to technical difficulties, internet issues. But I'm excited to introduce Tim Parent, VP of National Condo Co-op for all GRCs, Maddie Erickson, who is on camera with me, Divisional Manager of Condo Underwriting at GRA, and Amy Ramon, Condo Underwriter and Divisional Manager at GROP and PR. Like to abbreviate a lot of things here. So we're going to quickly launch our second poll before we kick everything off. All right, so when you get a chance, go ahead and vote, please.
Alrighty, we are waiting. We have about 65 of you who have voted in the poll. We'll wait a couple more seconds. All right, awesome. Got about 80% of you who have answered, so I will share that with the group. Thank you. So we've got 70% that said yes and 30% that said no.
Okay. All right, well then we're just going to dive in to our presentation and we're going to go for it. And I think, Tim, you're kicking off this section, right?
Yeah, thanks, Joanne. Thanks for the intro, and thank you everybody for attending. Thank you to the entire Grow team, Ella, Joanne, and many others behind the scenes. You know, this is a great mentorship series. I've observed from a close distance, a lot of these mentorship series, and been very honored to join today. I'm not who I am. I couldn't do what I do without my team, and so I'm very excited to you guys to hear from Maddie Erickson and Amy Ramon, and many of our other women leaders in this company. But yeah, today we're here to talk about obviously a lot of things condo related. There are new condo guidelines coming out, if you haven't heard, adding to the temporary guidelines that Fannie Mae and Freddie Mac launched last year. But we want to start with, like, if you take nothing away from this call, what are best practices? What can I do if I'm a realtor and a loan officer, and I don't want to absorb, line by line of every bit of this presentation, or can't, there's always so much mental energy in a day. So what we really like to start with is the best practices. So I'll try not to read line by line here, but if you do have a listing in a condo and you're a realtor, real estate professional, or an attorney, or even if you're a loan officer who works with listing agents, we want to know the name and the city, state, zip of the condo association. We can research our internal databases. We have years and years of past reviews. We keep all of our current reviews within the last year as up to date as we can. We can reuse information in some cases if we have a condo approved within the last year. And then what's growing, if you haven't seen or haven't heard, Fannie Mae has a growing condo database of approved condos and declined condos. And Freddie Mac is actually piloting with Guaranteed Rate. We're one of 5 lenders that were chosen to start building Freddie Mac's database of approved condos. So it's been pretty cool to see the agencies get involved and try to help streamline condo approvals if a condo is approved, or give you a heads up, hey, this condo might have issues and financing might be restricted. If possible, we would, a condo questionnaire and financials and the budget and the master insurance are really the three main docs, the three key docs that make up, I would say, 90–95% of what we review for conventional loans. We'll talk a little bit later. Maddie's an FHA/VA expert, so is Amy, of course, but we're talking a little more about FHA/VA and the differences there. But on the conventional or non-agency jumbo loan amount size, most of our investors are looking for a condo questionnaire, the budget and financials, and the master insurance. And you might be thinking, well, a budget's not required for limited review, and we can get into more of that granular stuff. I want to make sure we save time for Q&A, but those three docs are key. The other thing I like to point out is that it doesn't have to be a guarantee rate company's version of a questionnaire. A lot of HOAs in Chicagoland or even across the country use condosearch.com, homewisedocs.com. We can use those questionnaires. We've even seen other lender questionnaires. Especially if it's just a listing. We have some investors that might want an investor specific questionnaire, but for the most part, we can use other questionnaires, other versions of questionnaires, and those docs are key. A lot of times we'll get the resale certificate or rules and regs, and that stuff might be helpful, but those 3 docs are really the key: the questionnaire, the budget, and the master insurance. Sometimes those docs aren't available, or the HOA understandably and the property manager might charge for those docs. So even the 22.1 in Illinois, many of you, if you're on the call from Illinois, know what a 22.1 a resale certificate is. It does give some information. It can't be used in lieu of a questionnaire, but it does talk about, is there a special assessment in the project? Is there litigation in the project? So there is some high level information that wouldn't hurt. The 22.1 isn't going to be used in lieu of the questionnaire, but it will help. And then the other thing we do lean more and more on real estate agents, listing agents, buyers agents, the sellers themselves, on helping us get the questionnaire, the budget, financials, the rest of the condo docs as quickly as possible. I do feel empathy for property managers and HOAs. HOAs, homeowners associations, are board of directors, like almost like a fraternity, and they have regular 9 to 5s or something. They they can't sit around all day and answer lender questions and kind of questionnaires. And the same goes for the property managers. They have a full-time job. Their job is not to just complete condo docs, but the quicker we can get those docs, the better, as you probably have learned in some experience on condos. And sometimes if we don't stay on those third parties, they take a little bit longer, and now we're days from closing and just getting docs and finding issues, and that can be painful. So speed is key when it comes to getting those docs. And then the last thing, of course, is setting proper expectations. We'll talk more in the call about FHA VA, but sometimes FHA VA loans and condos that are not approved by HUD or the VA can typically take a little bit longer than a 30-day closing. Is it impossible to close a condo in less than 30 days if it's an FHA or VA loan that's not approved? No, it's not impossible. But it can be more time consuming, because there are things that are out of the lender's hands, where docs might have to be reviewed by HUD or the VA. So that's the high level stuff, obviously, and if you take nothing else away, that's really key. Now I think what the real draw to this, to the timing of this call, when Joanne came to us, said, hey, I know there's new guidelines coming out. We really want to focus on this call on deferred maintenance, critical repairs, special assessments, code violations. And so what does this mean? What's going on, right? And I'll try not to belabor the point, but there were temporary guidelines for the last year and a half that were published by Fannie and Freddie as a result of the FHFA's direction. The FHFA oversees Fannie Mae and Freddie Mac, and the FHFA directed Fannie and Freddie to publish new guidelines, taking a closer look at the condo's financial health and critical repairs. So this is a guideline. These are things that we've never looked at. Code violations, engineers reports, reserve studies we typically only would need them if the budget didn't contribute 10% on a full review. And special assessments themselves, there are really no guidelines on special assessments specific to the loan eligibility, other than, hey, make sure the borrower qualifies with that extra special assessment payment, right? So you might you're thinking, well, why all this fuss now? Condos have been a really viable, affordable housing part of lending, and they still are, and Fannie is committed to that. In fact, the head of Fannie Mae's condo policy wrote an email saying, with these new guidelines, we know many are concerned about Fannie's commitment to condo lending, but they are still very committed to making sure condos are affordable. At the same time, they want to protect the safety of our borrowers, and they want to protect the safety of your investment of the project. So, we are looking at things a lot closer, and that was obviously as a result of the Surfside condo collapse, and 98 people died in that collapse. So, not to sound too sobering, but it's a serious issue, and it called into question, hey, are we worried about the infrastructure, aging infrastructure? Condos that were built in the 70s, 80s, the quality of concrete isn't the same as it is today. So the temporary guidelines have been in effect. Many of you probably have heard, we're picking at special assessments, looking at meeting minutes, all these things. So now on July 5th, Fannie and Freddie said, hey, we're making our temporary guidelines permanent guidelines, and there are some subtle changes. So rather than go through line by line, what we wanted to highlight was just what's changed. And to be clear, the guides haven't changed a whole lot, but the guides are going into effect for applications on or after September 18th, 2023. And we wanted to keep it real high level to say what exactly has changed from the temporary guidelines. And every lender's up to their own interpretation. Every lender is required to follow Fannie Freddie guidelines. We have a close relationship with the GSEs, and we feel like we have a very close understanding of where we can and cannot take risk and what Fannie and Freddie expect of us. So before, under the temporary guidance, we would ask if there were any special assessments, significant deferred maintenance for major building components, or code violations. And if any of those were yes, then we'd ask for the additional documentation. The first change now is that even if there's no mention of a special assessment code violation or significant major building repair, lenders are asked to obtain any engineers, reporters, or inspections that were completed in the last 3 years. So that's going to be a question in our questionnaires. It'll be part of our checklist when you get late into September and these new guidelines are in effect. So in a nutshell, understandably, if the condo even voluntarily got an engineer's report to address something that they felt needed repairs, we're going to need to review that and take that into consideration. The thing that I really liked is I'm jumping around. The next bullet point is both Fannie and Freddie aligned their guidelines about special assessments. So no more than 15% of the units can be greater than 60 days delinquent on their special assessment payments. That's also a similar guideline to the full review guideline on regular assessments. So getting a little detailed here, but they want to make sure the condo is able to collect the special assessment. People aren't avoiding payment of the special assessment as a whole. That indicates some financial instability or disagreement about the need of the special assessment. So it's nice when they're aligned. They're not always aligned 100%, but they're pretty aligned on these guidelines. I'll blow through the rest of the slide, and then I definitely want to stop for some Q&A because I'm sure there's some good questions. But real quickly, Fannie and Freddie redefine the terms critical repairs, which are ineligible until the repairs are 100% completed. And the critical repairs are major building components that impact the safety, structural soundness, structural integrity, or habitability of the building. And it's also not just necessarily that our subject condo building doesn't have this issue, but other condos or other buildings in the project have the same issue. So, if there's deficiencies that, if left uncorrected, have the result to contribute in the system failure, any sort of water infiltration, mold, leaks into the project is obviously a concern. Any code violation that specific to structural soundness, habitability, or safety is also considered a critical repair. But I love how they said that, because you guys know, and many of you in the Chicagoland area know, the codes can be pretty picky. Hey, your back wrought iron stairs are starting to rust. You need to paint your stairs. Okay, that the stairwell is not deficient. It's not unsafe. But that still could be a code violation. Hey, your smoke detectors need new batteries. That's a code violation, but again, not necessarily every code violation is ineligible. Only when the code violation is specific to the structural soundness, safety, or habitability. They also kind of gave us a benchmark of any unfunded repairs costing more than $10,000 per unit. But then they also give you this caveat that says if the repairs are being funded through a special assessment, that could still meet guidelines too. So the thing I like to take away from this is not all repairs are ineligible, not all code violations are ineligible, and not all special assessments are ineligible. We're going to have to dissect them, and I think that is some of the pain in itself. But there is still objectivity for the lender to decide if it's a critical repair of a major building component that affects the safety, soundness, or habitability versus preventative maintenance. They even give us some examples. Seawalls is an interesting one because it's not attached to the building, but I do understand, if you had a collapsing seawall, that could create some flooding issues. Elevators, I have a love-hate relationship with elevators because some of them just need to be updated for modernization. If an elevator is closed because of a code violation, but you've got another working elevator that's up to code, that would still meet guidelines. The elevator just needs to be closed for safety issues while it's being repaired. But the big one we run into more often than not is water infiltration. Balconies versus decks is another great one. I think a back deck that, at least from our seat, again, every lender can make their own interpretation, but a back deck that is unsafe or not up to code that needs to be replaced, is still eligible during the repairs as long as the safety issue is alleviated. So if they've roped off the unfinished deck or the deck that's being disassembled and repaired, that still meets guidelines because, you know, there's really no safety issue once the deck is roped off. The deck can't fall and hurt anybody, versus a balcony that's obviously much more serious, where there could be a fall hazard, there could be a common area, a sidewalk, or a unit under that balcony that could be a serious issue, right? So the devil's in the details. You'll hear me say that a lot, unfortunately. Roofs are another great one, right? If a roof is at the end of its useful life, but it just needs to be replaced, it's not defective yet, it's just getting old and needs to be replaced, but they're doing a roof replacement, that still meets guidelines, even if it's through a special assessment. Whereas, you know, if a roof, we have a project in Florida where, you know, there's 16 buildings, 9 of the 16 buildings have their roof replaced, but 7 buildings have leaking roofs right now. And that's ineligible until the repairs are completed, even if our subject building is not one of the leaking roofs, right? Of course, your foundation, your electrical systems, your plumbing, you know, parking structures is a big one we saw in Chicago in a couple buildings, and they will right themselves, right? I mean, I think the good news is this will eventually, you know, hopefully the condo finishes the repairs and the condo will become eligible again. But I think real life examples really help. And I think, you know, the key is it preventative maintenance? Is it replacing something before it becomes a problem? Or is it a defect? Is something broken? Is something causing a concern? So I think there's one more slide, Ella, about, okay, well then how do you define, maybe back one. This is misconceptions.
Did it come through, Tim, or is it too far? Misconceptions?
I think it's too far. Yeah, we're not up to misconceptions quite yet. Well, it should be one back. Maybe I'm not seeing it all. Yeah, so the slide after this, there should be something about the definition of preventative maintenance. But preventative maintenance obviously is something that can be accomplished in the budget or through a special assessment. It doesn't have to be accomplished through the budget. Preventative maintenance, again, is trying to, you know, keep the existing useful life of the project, continue to keep the project serviceable. It might be a roof replacement, but at the same time, you know, a preventative routine repair is not ineligible. You know, they define it as preventative in nature and part of normal capital replacements focused on keeping the project fully functioning and serviceable. So again, we see elevator modernization. The elevator is not, you know, unsafe, but the elevator needs to be closed for some maintenance. The roofs need to be replaced, but the roofs weren't defective, they were just getting old, so we're replacing them before they become an issue. In Chicago, Philly, New York, you know, cold weather climates, the facades take a beating here, right? Our brick, we do a lot of tuck pointing. That's all preventative maintenance. But if an engineer's report or the HOA says, actually, we have water seeping behind our facade, we have water infiltration. Now we have to actually see how much damage the water infiltration did behind the facade or through the brick or through the concrete. That's where it becomes ineligible, right? So again, I hate to say it, but my favorite thing to say about these guidelines is the devil's in the details. So I said a lot. I know that's a lot of writing. Joanne, do you have any questions?
Yeah, and I will say it is a lot of writing, and I made them make it on multiple slides because it was too small for me to read. So yeah. It's a lot of detail, a lot of great information, and it's great to have it all kind of truncated into one place. So a couple of questions that have come through, and then even a couple of comments. One question I see that's a super easy answer, I think, is what is Form 22.1?
Oh, yeah. So if you aren't familiar with, in the state of Illinois, we have by law, a resale certificate called a 22.1. Other states, you know, have different laws, have different names for things, and it might just be called a resale certificate. Hey, here's how you get your mailbox. Here's how you, here's your HOA dues for your unit. Here's if they were delinquent on HOA dues. Here's a special assessment. So a 22.1 is specific to Illinois, but it's a resale certificate. It's not a condo questionnaire. It doesn't answer all the lender's information, but it can be helpful. So, you know, if you only have a 22.1, you can't get a questionnaire because you have to pay for the questionnaire. A 22.1 or a resale certificate might be helpful in the interim.
All right, and then a question that I have that came in says, age limit on roof, because you did mention the roof, and it happens in single family homes as well, or even a builder, like a building, what typically age-wise triggers these things? Is there like
that's such a great question.
Standard number?
Yeah, that's a great question. And the guides don't provide a standard number. You know, they expect that the HOA is monitoring the age of their roof. I think you'll see it, especially with these new guidelines coming out. You're seeing some other states react to this, right? There's state laws being passed as a reaction to the condo collapse. For example, Maryland and Florida passed laws saying condos have to get what's called a reserve study. and I don't want to divulge too, but this is a great question that relates to this. A reserve study is a professional engineer, a licensed engineer that goes out and inspects the building and all the major building components and says, this is the useful life, this is how much life you've got left of your roof. And then a CPA takes the engineer's data and says, here's how much the condo should be saving to replace all that stuff, right? So I think you're going to see a lot more condos get reserve studies. Many condos do have reserve studies. They're expensive, so you generally see it on bigger condos because it's, more major building components, less cost. On a 10-unit condo, it might not make sense, but reserve studies will tell us the age of the roof. So to answer the question, there's no guideline that says the age has to be this year or this many years left, but the guides say, hey, if your roof is at the end of its useful life, even if you need a special assessment, that's okay, but you want to replace it before it becomes a defect, before the roof starts leaking. We've had some where they say, well, we made temporary patchwork while we saved for the roof. That's ineligible. The minute you start having to put band-aids on bullet holes, for lack of a better term, that becomes, ineligible because, you've passed the useful life. So I've seen a lot of reserve studies. My guess is somewhere around 25 years on a brand new roof. But again, if you've got a roof from, 10, 20 years ago, it might not be as quality. So it depends on the type of roof. I'm not a roofing expert, but I would say somewhere between 20 and 25 years is the expected useful life of a roof.
Okay, I think we have like rapid fire questions coming in, and this is awesome. I love the interaction. We only get an hour and we have quite a bit to cover, so we might just do a couple like quick question answers, and then I think we'll probably just have to have Tim and Maddie and Amy help me get all these questions answered and out to everybody because I want to make sure everyone's questions are answered. But rapid fire, somebody answer. How long is a reserve study good for?
Love that question. 3 years from Fannie and Freddie. Some laws say you only need them every 5 years, but Fannie and Freddie are 3 years. Go ahead.
Okay, perfect. I've seen a lot of people also chime in with some best practices. That's awesome to share. Agree, getting the information up front is absolutely and totally and completely important. And we'll touch a little bit on that in the end as well, and where you can go and who you can go to. But another question that came in, and this is a great one considering how many issues I've recently seen with attached parking garages, but what about deferred maintenance on detached parking garages? Same thing?
That's a great question. Yeah, same thing still applies. It's a major building component. It could affect safety. The only thing, I'll give one example of a non-major building component, was a retaining wall. It was on the other side of the parking lot away from the building, and they roped off the parking spaces that were affected while they replaced the retaining wall. That's not a major building component, but a parking garage you have to use. We had a condo in Chicago that was ineligible with Fannie Mae because there were spaces where they couldn't even park on the parking lots. Now it's since been resolved, the condo is eligible again, but yeah, sorry for the longer answer to the short question.
Short answers, Tim, just kidding. Okay, this is a good question, and I think a lot of people won't know the answer to this. We should have done this as a poll question. Are these requirements only for condos with a specific amount of units, or are they all treated equally?
Oh, I love that question. I meant to bring it up too. Actually, it's a great question. It's any condo, attached condo with 5 or more units. So it does not apply to planned unit developments. And don't forget, in Chicago, townhomes are generally PUDs, but sometimes townhomes can be condos. We'll help you figure that out. But it does not apply to planned unit developments, detached condos, or 2 to 4 unit condos. It applies to every condo with 5 or more units that are attached.
And then also the part where you say we'll help you figure it out, quick tips. And I think Maddie and I brought this up on our Grow Condo call 2 years ago, how to figure out if you're a condo or not. Look at your legal description. If you're in Cook County, Illinois, and your last 4 digits of your PIN are 0, you're not a condo. If it's numbers, 1, 2, 3, 4, whatever, you're a condo. There's different tips and tricks for every county across the country. So make sure you're looking up your legal, not just because of condo warrantability, but also because of pricing on a loan with loan to values greater than 75%. So always something you want to be checking up front as the loan officer for sure. And honestly, as a listing agent too, because the more you're prepared on the listing side of things, the more things we can probably avoid. All right. And then it says Massachusetts has searchable land records for all deeds. Yeah, most counties do. Most counties, most states. So great information. There's just like so much coming into the chat.
Well,
which is great.
Yeah.
All right.
Sorry.
Yeah, go ahead, Tim.
Sorry, yeah, we'll keep going. And I think the next slides are Amy's slide. I'm excited to hand it off to Amy.
Okay, can I throw one more question out to you though, just because I think this is a good one, a real good one? What if the homeowner is responsible for their personal balcony? So think more like probably a townhouse structure, I would think.
Yeah, I love that question because it does happen. It could be a limited common element, and the HOA says, well, you have to repair it. Now, remember, if it's an isolated incident, if it's one balcony, one unit, that might change the story a little bit. But if a lot of people's balconies are having issues, I saw one where a condo said the windows are the unit owner's responsibility. It doesn't matter who the responsibility is. If it's a major building component, it needs to be repaired if it's critically defective. So if your balcony is in repair and you're responsible for it, that could affect other people's financing in the building.
All right, well, as we're flipping to the next section, Ella is going to launch our final poll. I remembered all the polls. This one, I feel like we should get 100% on this one if everybody's been paying attention to today, to the news, to everybody else. But the question is, which state has the most denied condos? Which state? And Ella, I can't see the options that I put down. I don't know if you can read them off.
Totally. We have California, Florida, Illinois, and New York. And we have people coming in with the answers. I'm able to see the answers come in live, so most of you are correct, but keep going. About 50% have voted. I'll give it a couple more seconds. Yeah, we have some people typing it into the chat as well. All right, I will close it now. And 75% of you were correct with Florida.
Yeah, Tim brought that up at the beginning of the call with the building that collapsed. And Florida is a little tougher right now when it comes to condo warrantability. So anyway, we're going to kick off our next section, other common misconceptions about condos. And can you all see the screen again, just because it takes it down when the polls are going up? Want to make sure it's up there. All right, is Amy there? We lose her.
I am here. Can you hear me?
Yeah, we can hear you.
Good. Okay, great. All right, wonderful. So every aspect of the condo review part of your file is important. So Tim covered the deferred maintenance stuff. I'm going to cover some topics, areas that we see a lot of confusion or a lot of scenarios that come in, or even files that are presented to us and say, hey, we think we have an issue here. And then it turns out it's not an issue. So we're just going to clarify a couple topics here in this section, and we're going to start with rental concentration. So Fannie Mae and Freddie Mac have guidelines that restrict the number of rentals that can be in a project. But this only applies to condominium projects that are either new construction or conversion, or if you're doing an investment transaction that requires a full review. So if you have an established condominium project and your transaction is for owner occupancy or second home, there are no owner occupancy percentages. You could be greater than 50% rented, and it's not going to impact the eligibility of the project. So for investment property transactions that don't qualify for a limited review and we need that full review, that's when your owner occupancy of 50% is needed. Otherwise, we don't have owner occupancy. So we get that a lot. That comes in with scenario questions that say, hey, we have a high investment concentration. We have a lot of rentals in this project. That doesn't automatically render your project ineligible. We have to look at the project composition, where the project is at. Is it new or established? And if it's established and an owner occupancy, primary or second home, you're good. There's no owner occupancy requirements. So that's a big one. Not as big as single entity ownership. We see that a lot. Single entity ownership, there are restrictions to these. So no single entity can own greater than the number of units allowed per guidelines. And there's different requirements depending on the size of the project. So in a 5 to 20 unit project, a single entity cannot own greater than 2 units for the project to be eligible. Then we have percentages if the project contains 21 or more units, and this is where some differences in Fannie Mae and Freddie Mac come in. Fannie Mae allows a single entity to own up to 20% of the units in the project and still be compliant when it has 21 or more units, while Freddie Mac allows a single entity ownership up to 25% of the units and still be eligible. So a single entity can own those percentages of units in those project sizes, and we're still okay. It's when they go over those. So if you have a 5 to 20 unit project and someone owns 3 units, then we have a problem. That's not guideline compliant. If you do run into a situation where we have single entity ownership in excess of the guidelines, Fannie Mae and Freddie Mac will allow a single entity ownership of up to 49% if the following apply. First, the subject unit has to be the purchase of one of those single entity owned units. So if you have a 20 unit project and someone owns 3, then your transaction needs to be one of those 3 units, which will decrease the number of units owned by that single entity. So that's the first thing. Then if that's the case, the project cannot have any pending or active special assessments. The single entity that owns the units within the project has got to be current on their HOA dues for all the units that they own. And then the single entity has to confirm that their intention is to bring their ownership percentage down to the allowable limits. So they plan on continuing to sell units and not retaining more than what the guidelines allow. So 20% with Fannie Mae, 25% with Freddie Mac, and then both Fannie and Freddie, 2 units in a 5 to 20 unit project. So if someone owns 4 units, they have to tell us that they intend to continue selling units until they own no more than 2. Hopefully that makes sense. Litigation, this is a super fun topic. There's so many different types of litigation, but the most important thing to understand is that the existence of litigation, the HOA involved in litigation, does not automatically render a project ineligible. So not all litigation is ineligible. And I'm going to use Tim's comment, devil in details. We need to know exactly what's going on with that litigation to determine if it's compliant with guidelines. So some of the big, some types of litigation that are ineligible are going to be litigation that's involving repairs for defective work or insurance claims that are not 100% complete. This will render the project ineligible. And examples of this would be construction defect litigation against the developer. So the HOA has identified some defects in the project and they're pursuing the developer to correct the work. If that work isn't 100% complete, it renders the project ineligible. Insurance claims, same thing. Massive damage to units within the project where they have to file a claim to their insurance company to obtain the funds to make those repairs. That's going to render the project ineligible if those repairs are not 100% complete. So ultimately, the lawsuit in those types of situations must only be for monetary recovery. Cannot be for, we have these defects and we need to repair them and we don't have the money, so you need to either repair them or give us the money to do that. So the repairs have to be 100% complete. One of the changes in the guidelines that's happened recently is that in the past, only active litigation needed to be reviewed. And most recently, I believe within the last 2 years, they've added pre-litigation activity. So even if the litigation is not formally filed yet, but there's pre-litigation activity like mediation or arbitration, we must review those pre-litigation activity cases to make sure that they're compliant with guidelines. Now, an example of this would be construction defect litigation that hasn't formally been filed yet, but the association has filed a notice to builder. If there's a notice to builder that's been filed, they're initiating those legal proceedings and we would have to review that for compliance. This bottom bullet point here about personal injury lawsuits, I'm going to expand that. It could be personal injury lawsuits, property damage, internal disputes between unit owners or unit owners against the association. That is a bulk of the litigation that we see. And there's general guidance that we need to follow when we run into litigation of this nature. When the association is the defendant, We need to make sure one of two things are present. We need to either make sure that the association's insurance carrier is defending the case and that the insurance policy is likely to cover the monetary damages sought in the case. That it's a standard. That's what we need. Sometimes we find that the association has either decided not to file the claim to the insurance, or the insurance has rejected the claim, which means that there's no insurance coverage. Doesn't necessarily mean we can't proceed. There's just another route we have to take, and that would be confirmation that the damages will not exceed 10% of the current funded HOA's reserve balance. So in that case, we would need confirmation of an estimated range of damages, either an exact amount of damages or a range of damages, so we can see exactly what the HOA might be liable for. Then what we would need to see is a recent HOA balance sheets to confirm that those amount of damages or the estimated damages do not exceed 10% of the HOA's funded reserves. So that's litigation. Condo hotels, this is huge too. Condo hotels, I get questions all the time about condo hotels. Either another lender's rejected the project because of a condo hotel, or hey, I'm in Florida and it's a resort area and I just need to make sure that we're able to proceed. So what's important to understand is that there is no legal definition of a condo hotel. Only what Fannie Mae and Freddie Mac require in their guidelines to confirm if the project is operating or functioning like a condo hotel. So in short, Fannie Mae is more strict than Freddie Mac, and I'm going to explain why. Fannie Mae's guidelines are very strict in that if a majority of the units are used for transient use, we're not going to be able to proceed. High number of transient use rentals, Fannie Mae, they just don't like it. They also rely more heavily on what's published and marketed online. That's Fannie Mae's concern, is how are the unit owners using their units? How are the units being marketed online? Are they on Airbnb, VRBO? Are there Expedia? Are there hotel ratings? That's more of what Fannie Mae looks at. So it's a lot of diving on our part to look in to see what that marketing is what kind of marketing is being published online. Freddie Mac, however, takes a different stance. They do allow projects where a majority of the units are used for short-term rentals or transient use, but they rely more heavily on the eligibility status, on the involvement of the HOA and property manager in that short-term rental program or process. So we would have to look more at the HOA's legal documents, the property management agreements. There's specific questions that we need to ask the HOA to provide answers to. Are there rental tax that's paid? Does the association charge the unit owner to rent their units? Do they get a cut of it? Do they manage and allow and have on-site check-in desks, registration desks? Does the property manager that's managing the association also help facilitate the rental program? Are there mandatory rental programs? So Freddie Mac is a little bit more concerned with how legally the project is organized and how it operates with the HOA and property management involvement, while Fannie Mae relies more on what the individual unit owners are doing with their unit. Are they marketing it for rental on popular websites? And are the listings for those units marketing it as a investment opportunity for transient use? So if we were to go into a real estate ad, right? And we see that the description for the unit for sale indicates great investment opportunity and already multiple bookings for the rest of the year that would roll over to the new owner. Those are the kind of things that Fannie Mae is going to be concerned about, but not so much Freddie Mac. So condo hotels, investigate, look at them, and never hesitate to reach out to us for help on those, because we understand the guidelines pretty well with the differences between Fannie Mae and Freddie Mac. I have found too, as a side note, that Fannie Mae their ineligible list, there are a lot of projects out there on Fannie Mae's ineligible list for condo hotels, but the good news is that there are many of them that we have found after we've investigated them that are compliant with Freddie Mac guidelines. So just because it's ineligible to Fannie Mae doesn't necessarily mean it's going to be ineligible to Freddie Mac. So don't let that deter you from investigating further. If you just see it as ineligible on Fannie Mae's list, let's look at Freddie Mac. Let's see if Freddie Mac's guidelines would apply and we'd be able to proceed. Insurance is the last section here. Oh,
hey, Amy, I just want to
sure.
jump in really quick because in the chat, so many questions are, is Fannie better? Is Freddie better? Is Fannie? And it's like, from what everything I'm hearing, it just depends. You have to do, I loved your word investigate. Like, I feel like sometimes you're condo investigators, you're investigating things. And I just think that's a really good like call out, like just because it doesn't work with one doesn't mean it can't work with the other. So I just wanted to point that out because it's like, I've seen at least 7 questions that all kind of have that variation of which one's better. So sorry.
And to elaborate on that, to elaborate on that just a little bit too, is that Fannie and Freddie have a majority of the guidelines are the same for both Fannie and Freddie, right? And I can tell you that for condo hotels, Freddie Mac, like I said, relies more heavily on what the HOA is doing and the property manager is doing, while Fannie Mae is more the unit owners. HOAs can't always monitor and control what the unit owners are doing with their units. If it's not prohibited in the legal documents, those unit owners can offer their units for nightly or transient use. And that's not, the whole association shouldn't be penalized for that. So I like Freddie Mac's guidelines a lot better there. So I would say Freddie Mac is a little bit easier on the condo hotel piece, while say Fannie Mae is a little bit more lenient on the litigation side. So there's definitely differences in specific components of the guidelines where Fannie Mae is a little bit more lenient. And then in others, Freddie Mac is a little bit more lenient. So that's when you come to the experts and we can kind of help you weed through the documents that you have in the information and find the best fit. That's what we do, is figure out where we can put this based on the information that we have. And when in doubt, just ask more questions. Even if I'm looking at something today and I'm on the fence, then I'm just going to ask for additional data and additional information to see where we end up. Okay, insurance. Insurance kind of gives me a headache, honestly. There's so many changes with insurance that the guidelines do a really great job explaining it though. But there are so many changes with insurance throughout the industry, throughout the country, different regions. So we have to make sure that we're up to date with all of our insurance knowledge. The most important factors that we're looking at with HOA master insurance is that the project must have replacement costs, not just replacement cost, 100% replacement cost. So actual cash value coverage, not allowed. We can't have a project that has the actual cash value insurance coverage in lieu of replacement costs. So that's a big no-no. Deductibles cannot exceed 5%. And this is an area that we're seeing a lot more insurance policies with higher deductibles, and there is just no workaround for this. There's no workaround when the insurance deductible exceeds 5%. So that's a big one that we're seeing lately. If there's co-insurance present, extra work is going to be required to confirm that the policy is equal to 100% of the replacement cost or insurable value of the project. It's not the same as a replacement cost endorsement. So if there's a co-insurance provision on the HOA's property insurance, you will get conditioned for additional or be asked for additional documentation to prove that the amount of coverage that the HOA currently carries is equal to 100% of the insurable value. So that can mean replacement cost estimators or project appraisals to determine what the replacement cost value is, and then we compare that to the amount that the association is actually carrying in property coverage. And the HOA's insurance cannot exclude building ordinance or law coverage. If it's excluded, it's going to render the project ineligible. In addition to that, the HOA must provide sufficient liability and fidelity bond coverage, which is also called crime and employee dishonesty, but that's only required under full review guidelines. So property insurance requirements apply to all review types. And then for full reviews only, we have to then take a look at the HOA's liability and the fidelity bond coverage to make sure that it's compliant with guidelines. I think that's all I got there.
Yep, and we have a zillion questions, which is awesome, but we could have done a 2-hour call and still probably not gotten to all of the questions and all of the information. So I'm just going to pitch just a couple to you, and then Maddie has a few slides that are super important. So if everyone doesn't mind hanging out for a couple of extra minutes and has the time, we might just go a little bit over the hour. But quick question, just because we don't have it on here, and I think we just take for granted that people know, but loan to value difference between full and limited review was one of the questions.
So outside of the state of Florida, established projects qualify for a limited review up to 90% LTV. In Florida, it's, my gosh, 75% LTV, and that's for primary and second homes. Primary and second homes. Investment transactions, limited reviews are allowed up to 75% LTV outside of Florida, and then for Florida, it's 70%.
And I think everybody here, if there's anyone from Florida on here, sorry, or licensed in Florida like myself, it's a little tougher to do these condos. We'll pitch one more question and then we'll go to the next slides, Amy. But it says, this is a good one. In the case of personal injury litigation, who can verify that the insurance policy will likely cover monetary damages?
That's a great question. We really would like to see the information come from the attorney representing the association. In certain circumstances, depending on the information presented, we could also take that information from the property manager, homeowners association, or the insurance carrier themselves. And just to one little note on that too, the litigation documentation, copies of the complaints and attorney's letters, they can come from the association, they can come from the attorney. Don't rely solely on reaching out to the insurance, the HOA's insurance for information regarding litigation. They're the ones, processing the claim, and getting information to satisfy the guidelines are not always provided by the insurance carrier. So I would rely more heavily on the attorneys and the HOA and property manager.
All right, let's see. We have, can you see the screen, Maddie? You're next.
I sure can.
You're up next. I can hear you perfectly fine. So
Okay,
let's
good.
just dive into the FHA, VA condo approvals, non-warrantable condos. Lots of fun things on 2 slides to cover. So
I know.
again,
I'll
this
try
could be
and
a
get through it
separate class. So
quickly as I
dive
can.
in.
But FHA and VA
we'll
are
take a
my
little
favorite
extra
condo
time because
approvals.
we have a couple of questions too. So don't worry about that. We'll go a little bit over.
Awesome. All right. So FHA and VA condo guidelines are much different than conventional or non-agency loans. The approval process does require a ton more documentation, and in most cases, the guidelines are going to be much more strict than conventional. A couple examples of this would be on an FHA full project approval, where we're having to scour the legal docs for leasing restrictions or ineligible types of right of first refusal. For all VA reviews and some of the FHA reviews, docs need to be sent directly to the VA or to HUD for them to review. A couple different examples of something that would need to be sent to HUD is a gut or a non-gut conversion. If there's any sort of owner occupancy that needs HUD sign off, we have to send it directly to them. So depending on the situation and the scenario, we, estimate when we talk with loan officers and referral partners that these loans that are not FHA, VA approved can, incur a 45+ day closing, because we just don't know what we're going to see in the docs. as Tim and Amy both said, the devil is in the details, and there's so many variables with FHA and VA approvals. So we can't just say, oh yeah, you're good, 3 business day turn time. The next type of condos are non-warrantable condos, and they're all over the country. But we do, here at the Guaranteed Rate Companies, we do have non-warrantable condo investors, and these investors can expand on some Fannie Freddie guidelines, but not all guidelines. That's super important. So each of our non-warrantable investors do have different processes, different guidelines, requirements, et cetera, just to determine if they're going to consider taking that type of risk. And so when they expand on the traditional Fannie Freddie guidelines, obviously. So some are restricted geographically by loan size. So really, again, best practice is to get in contact with us. Tell us what your situation is, why it's non-warrantable. If there's been problems lending in the project and your realtor has said, hey, nobody's lending in here. Well, we want to know why. And then we can get the documents and we'll explain, what, if any, options are available to you when we fall outside the Fannie and Freddie guidelines. So, just as a word, words of wisdom, these products are going to have much higher rates. They're going to have more strict credit requirements because the investor is taking a little bit more risk on expanding the condo guidelines outside of Fannie and Freddie's standard guidelines. All right, lastly, we'll get into it. Co-ops. Co-ops are much, much more risky than condos, and that's because it's, by way of the loans are closed. The mortgage registration process and then transfer of servicing all has to be done manually. Fannie and Freddie are typically only lending on condos in very, very limited geographic areas. We see New Jersey, New York, some parts of Chicago, and I think I've seen a few in Washington, D.C. and in Florida as well. Sorry. There are products we have that are like non-warrantable that will only lend on co-ops and other markets that Fannie and Freddie are not comfortable with, and that do come with higher rates as well. Back to you in the studio, Joanne.
Yeah, a couple questions coming in. Spot approval for FHA versus full approval for FHA. What's
single
easier?
unit approval? Single unit approval every time.
Okay, and then VA does not have a spot approval, just a full,
Correct.
just the full, correct? Okay.
Just the full.
So
and we are not delegated for them.
Okay, so yeah, so that's like you said, setting expectations, going to take a little bit of extra time. I think that's also part of what we wanted to convey on this call from a real estate agent perspective. If you're the listing agent, if you're the buyer's agent, setting expectations, if certain circumstances arise or certain buyers come in to purchase the listing. If you're the loan officer, also setting those expectations, making sure your team is all on the same page and everything as well. It's really important to make sure that everybody is on the same page. All right, so I have somebody here, Maddie, that's saying, can you explain the FHA single unit approval?
Yeah, I'll try and explain it
in a sentence.
nutshell.
In one sentence, Maddie, please. Thank you.
A single unit approval is not a full project approval, and so virtually any FHA lender can do these approvals. They require a case number pull real quick, and they are much easier than the full project approvals because there is not as much documentation or checks and balances during our review than what's required of us on a full project approval. So they're much easier.
And then also for those types of approvals, what percentage of investor concentration are we looking at?
So single entity well, there's two investment concentrations, I suppose. So no more than 50% of the project can be rented. And then on the other side of the coin, for single entity ownership, in 2019, HUD reduced the single entity ownership percentage from 50% back down to 10%. That also will apply to single unit approval as well.
That's a huge difference, like 50 to 10.
Yeah.
Also, it's interesting to see, like, you know, we've had a lot of different programs and products open up to us this year. And so to see how, in some respect with condos, some things have gotten tougher and some things have gotten easier. So it's not all doom and gloom, which is great, which I hope is one thing that everybody did get out of this call today. New construction, FHA, VA, not unless the whole project is approved, correct?
Yeah, so new construction is not going to, it's going to kick you out of single unit approval territory for sure. But it is doable on a full project approval. We're just looking for much more documentation. There are certain pre-sales that have to be met. I believe under FHA it's 30%. And then of course there's going to be, depending on the construction type, if it's a new construction, we can typically do that in-house under our DELRAP HUD approval authority. Or if it's a new conversion, then we have to send that into HUD. But it really all depends, but it is doable.
So someone did put in the chat, be careful on the timeline for the new construction. So I think that's just a really big point out of setting good expectations and being a good communicator. So 100%. we are not going to get to all of these questions. There's so many amazing questions. I think we touched on a lot of ones that were coming in like on a repetitive basis, which is great. So we'll get our condo team. I'm going to give our condo team some homework. Like they don't do enough for us already. And they'll get together, they'll put the heads together and answer some of these questions for us so that we can include it in, we'll send out an email next week with all of the information, and then also it'll get uploaded to your intranet or your resource center, just like the recording for this call. If you have a team member or someone you manage or a referral partner that wasn't able to make today's call, they can go back and watch it. I would highly recommend that you all start having conversations with the people that you work with about condos. This was I believe our highest attended Grow call ever, not just for the mentorship series, but for all of Grow. Who knew condos were so exciting? There's a big demand for this knowledge. I'm really thankful to Tim and to Maddie and to Amy for being here, not just for being here and just, you know, for this hour, but everything that they do for all of Guaranteed Rate companies, everything that they did to prep for this call. It's just really such great information. The one thing I wanted to leave everyone with was, and that's this last little bullet point here on your screen, is kind of look up, research who to reach out to if you have a question. Well, that's going to depend on who you are. If you're a loan officer, you have some pretty great resources on your intranet or resource center. You have your Fannie Mae approved and ineligible list, correct? You have your Freddie Mac list for approved condos, and then we have our GRC condo database, which covers all of our GRCs, if I'm not mistaken. So we can see everything across all companies, which is pretty awesome. I mean, if you work at a bank, you're just going to see your bank stuff. Maybe you don't even have access to it. I don't know how they operate, but we have a lot of transparency here, which is really great, and access to a lot of information. If you are a pod member or a loan officer, you can ask internally. There are distributions that you can email if you have questions or need to run something by you. Definitely make sure you're encouraging your agents to run things by you ahead of time. Just if they're taking a listing and they're not 100% sure on something, or if they just don't even know where to start, or if you have a buyer putting in an offer. How many times do we do pre-approvals over the weekend where we're trying to get everything done, and then it's a condo and we want to make sure that everything's good with the condo, and we're telling the listing agent, hey, just making sure there's no pending litigation, special assessments, deferred maintenance is part of my new scripting that I use when I'm doing that. So just making sure that we're giving all of that information out there. If you're a real estate agent or an attorney and you have questions, reach out to your loan officer at Proper Rate, Origin Point, Guarantee Rate Affinity, Guaranteed Rate Inc. We're all here for you and ready to help answer any questions and be your experts when it comes to condos. And I just special thank you for joining us today for our special mentorship series. It included all of our GRCs and our referral partners. So awesome to have you all. And until next time, have a great rest of your day, everybody.
Thanks, Joanne. Thanks, team. Thanks,
Thanks,
Ella.
Rick.
Thank you.
Thanks, Joanne.